We are going to be analyzing this duplex in Torrance and seeing whether it is actually worth investing in and whether it would qualify for a traditional investor mortgage. This is a probate option, so it will likely go for more than the listed price, but we're going to see whether it's even worth the base minimum listed price of $799. Got the address there, got the link there. Yearly inflation, I put this based on the past 100 years, even though it's higher in recent history, especially after 2020. But I think looking at it on a 100-year basis is good practice. Yearly appreciation, that's what it is about nationwide, but this is a California property, and more specifically a property in Los Angeles County, and those tend to have an appreciation of 8% per year. Rental inflation nationwide and in California are about 3%, even though there's a rent control law in California limiting max inflation to 5% plus inflation. So technically, rental inflation could be 7% a year, but they still have to compete with other landlords for tenants, and that's what prevents it from going up that high every year. I'm not saying there aren't places that have gone up that high, but if we look at the statistics, they're generally lower. They're around this much. Stock market gains, past 10 years, past 30 years, averages about 7.5%, even accounting for inflation. Property taxes in California are actually closer to 1.25%. Vacancy, this is just what we use as mortgage lenders when qualifying a traditional mortgage on a rental property, on an investment property. So that means FHA loans, conventional loans, VA loans. We would qualify it based on a 25% vacancy rate. Rehab costs, I have no idea what it would cost. This is a probate auction, so I'm guessing somebody died and they got to sell it so they can divide it up amongst the heirs or pay off their outstanding debts. So it would probably need at least 15 grand, and the price is $799. Down payment on investment properties, you need at least 25% down. Interest rates are about 8% right now for investors. For people that are going to be occupying the property, it's lower, around 6.5 to 7.5%, depending upon your credit history. The rest of these blue boxes break down what these would cost every year. So at the end of the first year, you'd have zero in mortgage insurance, because mortgage insurance is required on properties with less than 20% down. So if I would pay 15% down, you'll see that I need mortgage insurance. And this is the yearly cost, not a monthly cost. But at 25% down, because it is more than the 20% minimum, it goes to zero. Your principal payments, this is how much money goes towards the principal of the loan every single year, every single month on average. So at the start, you're paying $402, and every single year you'll see that the principal payments get more and more, but that the total monthly payment remains the same, $43.9708, $43.9708. That would be your monthly payment. And if you were to add all that up, this is what you're borrowing, and this is what you would have to pay off. In interest, you would be paying almost $1 million, so that's more than the loan itself. And total, you would have paid almost $1.6 million on an $800,000 house. So that's twice as much. Rehab cost financed. So this is assuming you borrowed $15,000 and in order to pay it off, in order to get it into, in order to fix up the property and get it ready to rent. And over 30 years, fixed at a fixed interest rate, you would have repay 40 grand. But it only costs you $110 every month. So you can either pay that 15 grand out of pocket or finance it. Total monthly payments with the rehab cost finance is $4507.15. And again, this is what you would pay over 30 years for an $800,000 duplex. But it's not about what you pay out of pocket over time. It's more about how much you make on it, how much profit you make. And these are the closing costs. Closing costs are generally 2 to 5%. I put it at 2% here. You can change that, put it at 3%. Realtor commissions as buyers, for buyers agents, 3%, for sellers agents, 3%. And what happens is that they usually take 6% and split it off. Split it between them up until that recent NAR ruling prohibiting that. So this is your out-of-pocket cost right here. This is your out-of-pocket cost the very first month buying that place. And these are your out-of-pocket costs at the end of the very first year. These are your yearly expenditures right here. And this is what it adds up to every single year after that. So at the end of 30 years, out-of-pocket, you spent $1.8 million. this is the one thing I've not changed right here, is projected ARV price, or projected after repair value. So after you fix it up, how much is this property worth? And we can go down here and take a look. So this is a duplex. Duplexes generally go for about $400,000 per unit in Torrance. There's 838,800, so that's what I'm going to put right there because it's lower, allowing it to be more conservative. So yeah, you spent you spent $1.9 million on this over 30 years. But if you take into account the yearly appreciation, after 5 years, your equity, after you discount all the money you've already put into the place, is only $60,000. That's like $12,000 a year, hardly worth it. But the 10th year, it's $368,000. Year 20, it's $2 million. 30th year, it's $6 million. And again, this is after you subtract all the money you've already sunk into it. So you've sunk in $1.8 million after 30 years just on owning it. I'm not talking about operations. I'm not talking about utilities or home insurance or property taxes. I'm not talking about maintenance costs or property management fees or anything like that. I'm just talking about the cost of buying it. You have sunk in $1.9 million to buy an $800,000 house, but if you were to sell it at the end of 30 years, you would get back $6 million. You would get back $7.8 million. That's the projected price after 30 years on an $800,000 property, almost 10x in it. But cash in hand afterwards, you would be left with about $5.9 million, or almost $6 million. So that's why people buy rental properties. That's why people invest. But you got to do it for the long term, and you got to be able to survive these hard years, which are the first 2 to 4 years. I've done these in intervals: 2nd, 5th, 10th, 20th, 30th. So we can assume that it actually breaks even somewhere between the 2nd and 5th year. Let's see here. Rental income, if you were to rent these out. So this is a duplex. And we can go to Pad Mapper. First, we want to see where this place is located. It's located in Torrance, on Plaza del Amo and Western Avenue. And I've already got this set up. Western Avenue, Plaza del Amo. So this one right here is not a good match, because even though it says $3 grand, and we're like, oh man, that's what you're getting for a single unit. No, this is a single family home. So it's going to be priced a little bit more expensively. But if we look at this, for example, there's a 1 bed, 1 bath. This is priced at $2,300. This looks like 3 beds, 2 baths, so that's why it's at $7 grand a month. There's 2 beds, 1 bath. This might be a duplex, it might be a single family, I'm not exactly sure. Let's see what it says. Yeah, this is a duplex, and that's good because it gives us some idea of what we can get in rents for this, which is also a 2 bed, 1 bath, and 1 bedroom, 3/4 bath, with a bonus roof leak. But we again want to be conservative. So here's Crow Ridge Apartments. This is not a duplex, this is a big building. So they're saying 2 bedrooms are $2,100 and 1 bedroom is $1,750. So it looks like this is somewhere between $2,500 and $2,100. Somewhere between $2,500 and $2,100. So let's see, 2,100 plus 2,500 divided by 2. 2,100 plus 2,500 divided by 2. 2,300. So that's what we would get for the 2 bedroom. And we could get about $1,750 for the 1 bedroom. 2,300 plus 1,750 divided by 2. So about $2 grand per unit. And here's the thing, you might want to buy this for an Airbnb or a midterm rental, which is different from Airbnb. But when qualifying traditional mortgages, conventional loans, and FHA loans and VA loans, we only look at long-term rents. We do not look at the fact that you could earn 4 grand per month as an Airbnb or 3 grand per month as an Airbnb. We just look strictly at the long-term rents because that's an established business model over the past 100 years, maybe 3,000 years, who knows. But it's an established business model. Airbnb is still too new. So this is what our total income would be per year. So at the end of the first month, we could expect 3 grand in income because of the 25% vacancy rate. So yeah, even though the monthly income is 4 grand per month, we do calculate this vacancy rate into that so that we can protect our downside and make sure that even with a 25% vacancy, that all the rents that you collect are more than enough to cover the loan payments. And as we saw here, the loan payments on just principal and interest alone is $4,400 a month, and your total income with vacancy rates calculated into it are $3,000 a month. Right away, we are seeing that these numbers don't work out. But that doesn't mean, even as is, this property isn't worth it, because between the equity between the net equity and total income after 30 years, you're still at 7 million. And let's say your total expenses. For property management, it's already done automatically. So where property management, you can either pay flat fee, like $100 a unit, $200 a unit, whatever it is, or just pay 10% rent, which is the more traditional way of doing it. It's usually between 8 to 12%. So let's see what we get as a result. So your first year, you're looking at paying $2,400 in property management fees. Gas, again, maybe $50 per unit, so $100. Water, again, $50 per unit, so $100. Electric, keep it like that. And that's assuming you're paying it. If you're just doing traditional rental, you may not have to pay anything. Let me see if there's any HOAs here. Usually they have HOA information here, and it doesn't look like they do have an HOA, so that's good. Less monthly costs. Legal costs, maybe $1,500 per year, evicting tenants and stuff that don't pay. Maintenance is usually about 10% of monthly income averaged out. So for example, if you look at the end of 30 years, it doesn't seem unreasonable you would spend $200,000 over the lifetime of the loan on this property based on how bad condition it was. That's furnace replacements, water heater replacements, roof replacement, foundation repairs, and who knows what else. So at the start, as a rental property, when you start renting it out, these are your costs from the get-go. Or $50 a month. Let me see what did I do here. Yeah. So, I mean, we could expect to spend $2,400 maintenance. That's $8,700. Yeah. So these are about your yearly costs, and this is what it would cost you on a monthly basis in the first year, $725. So that means here's your net operating, and here's your total income, and then you subtract your yearly costs from it, and you end up with your net operating income. And then you subtract your home insurance and property taxes, and you end up with your net income. So yeah, and that's also including everything you spent here on the financing of the property. So you did spend $293,000, almost $294,000 out of pocket your first year. If you're expecting to make more than that in rent on your first year on any property, you're sorely mistaken. So this is how much in the hole you end up with at the end of your first year. But at the end of the second year, you can see you already dropped more than $200,000, $240,000 about. And from there on, you just sort of slowly start climbing out or climbing worse, based on costs. So yeah, here's your total income, and then after you get rid of all these costs here, and your property taxes and insurance and financing costs, you actually end up spending $1.6 million out of pocket. And that's on top of the $1.8 million that you spent buying the property. So in absolute terms, you're like 1.6, 1.8, that's what, $3.5 million. But you have equity, and that's where the real wealth comes in after 30 years. You're at 6 million. And if you were to look at all this and add it up, at the end of it all, after 30 years, after you rented it out for 30 years, and you sold it, you would end up with $4 million, $4.3 million in your pocket. And this is why the inflation rate is important. I'm backtracking here. Prices rise. So when you sign a mortgage, when you get a loan for a mortgage, your interest rate stays fixed and your monthly payments stay fixed. But normally when you get an escrow account on a mortgage, you also got to pay property taxes and home insurance. And those go up as home prices go up and insurance costs go up. And so like if we look here, the first year, insurance is $1,260. On something like this, that's what I guess this property is probably going to get. Maybe it'll be like $2,000. So your first year of insurance, you're going to pay $2,000, but then it goes up to second year to $2,045. Maybe it jumped up to $2,200 and it stays the same, but averaged out over 30 years with the rate of inflation at 2.26%, you're probably looking at something similar to this. So that by the end of the 30th year, your insurance payments that start out as $2,000 a year are now almost $4,000 a year, and your property taxes have also gone up, starting from 1.25% or $10,000 to almost $93,000 per year. And every single year you're losing money. So how are you going to make these payments, dude? You're earning $36,000 a year in rent, but your yearly spend is about $50,000. So you're pulling $20,000 out of your pocket every year. It just doesn't make sense. You're better off, putting that money into the stock market. And by that I mean, you start with the down payment and then your monthly mortgage payment, just mortgage and interest. And if you do that every single month for the next 30 years, you end up with $7.6 million in stocks that you only had to spend $1.8 million to get. And your net equity is, or if you were to sell all your stocks and then subtract all the money you put into getting it, you would end up with $5.7 million. The difference between that rental property and the stock market is that some of these stocks actually give you yields or dividends. And I also map that out with a 5% yield and a 10% yield, or 5% dividends, 10% dividends. And you start making a profit in the 5th year. So that means all the dividends you get, assuming the entire portfolio paid 10%, yeah, you're making a profit. They're paying for itself by the 5th year. If you're doing 5% dividends, then you're turning a profit up in your 10th year. That means all the dividends are paying your monthly investments in the 10th year. And at the end of the 30 years, you end up with between $50 to $100 million. That's the power of compounding interest. That's the power of equity and appreciation. To make this property work, I think you would have to do it as an Airbnb. And this listing only has 2 photos, so we don't even know what it looks like from the inside. That means we don't even know how much work is necessary to get it into Airbnb condition, not to mention all the expenditures and costs on furnishing it up. I've noticed that Canadian sites generally are very, very slow. And so, like, this property, we're located in Inglewood. Revenue potential, I don't care about occupancy, I don't care about the daily rate, I look at what it earns in a year. $37,200. And think about that, that's more than $2,000 a month in rent. $2,000 a month in rent is $24,000 a year per unit. Let me do that. So Torrance, you're looking at about 50 grand per year. And you need a special permit to do a year, which is an added cost, and you have to pay extra taxes on top of that. I wouldn't be able to calculate that off the top of my head right now. But you got 2 units, let's say 4 grand, which is $48,000. And now let's see how these numbers look. So your first year, you're losing money. You actually make money in your 20th year, but then in the 30th year, you again lose money because of increased property taxes, which have almost doubled. So at the end of it, you're losing money, but a lot less money. Here's your total net income, and then you add it to the net equity, and you end up with $5.7 million in net profits, which is more than the 4.3. Which, I mean, if you were just put it in the stock market, you're still doing better at the end of the 2nd year. It'll take you 5 years here to get into the positive equity territory, whereas in the stock market it will only take you 2 years. So this is why people say now's a horrible time to buy a house. Let's see this interest rate if it was 3.99%. That means interest rates for normal buyers would have to be about 2.5%. And yeah, now rental properties make sense. You're still losing at the end of your first year, but your 2nd year as an Airbnb, you're cash flow positive. And again, this does not take into account, say, depreciation of the building. It does not take into account your interest payment write-offs. None of that. So even if you did that, those are paper profits, because that's just money you don't have to spend on taxes. It's not money that's actually flowing into your account. So again, cash flow matters, especially when trying to qualify property. So rents would need to be about $4,000 a month per unit in order to justify buying this. But there is another way this property makes sense. And let's say interest rate is 8%, but you put down 100%, so you're not borrowing money to buy this. You do not borrow money to buy this at all. You're still going to have closing costs, you're still going to have realtor commissions, and you're still going to have rehab costs. None of that changes. But now, look at your cash flow. And so this is why big investors and corporations are able to buy homes in California and turn them into rental properties, whether single family homes or multifamilies. They are the ones with the cash to buy an $800,000 house, duplex, without having to get it financed. So these properties make sense. These properties turn a profit. It just depends on how much cash you have and whether you can survive the losing years. But at the end of it all, you're able to walk out with more money than you put in. And that's the thing that matters.